higher oil prices. Somehow we're going to have this big bounce in growth and inflation is not going to go away. It's going to go away. This is an old cat bounce, and this cat's going to have less bounce in it going forward. Inflation's dying. There's still a window for a soft landing.
So this JP Morgan analyst does believe that inflation is dying. Can we agree with them, right? Oil prices are going up, but we want to make sure we look at the worst case scenario here. So that's what we're going to check out. Oil going higher does create a worst case scenario. So we are going to dive into that right now. Just taking a look at first, it's not the economy that is weak. Okay, let's just keep that in mind. Atlanta GDP, so estimates for GDP are higher, right? The worst case scenario is not a recession right now. It is inflation resurging, the Fed hiking rates for the stock market, and expectations going up, right? That could cause a recession in the future, but it doesn't look like it's going to be in 2023. We talked about that yesterday, right? We got initial jobless claims this morning. And if we look at the trend, initial jobless claims in general are starting to roll back over, right? So the economy is strong. That's not the issue here. The issue here, right? And this is the Fed. This is the Fed actually, the nowcast, the Cleveland nowcast for inflation. And they're expecting inflation to tick up over the next couple months, right? August, 3.8% headline. And then pretty much the same, 3.85 into September, right? And we're going to get this print, right? This inflation print coming up here, the 14th, a week from today, I believe. And then we're going to get the Fed's decision September 20th. So we're going to keep this in mind, right? So they're expecting higher inflation, right? What does that do to the market? What is the real risk here? The real risk here for the overall market, the worst case scenario is that the trend of headline inflation starts to move back up. We had a small bump in July. We had a small bump. What is August going to look like? 3.3, right? 3.4? I don't know. We don't know. And so if this trend starts, where does the trend actually change? Is it 3.4%, 3.5? I think it's above the previous high, right? This is not technical analysis, but if we do get above May's inflation, we're going to be in trouble here, right? The market's definitely not going to like that. And we're going to go over why that actually causes a huge risk. Oil surging is a big risk to the market, right? So next, we don't want that reflation. Now, this is what the market's concerned with. This is what all the bears are taking a look at. Is this 1970s all over again? Inflation spikes, it comes back down, and it starts to re-accelerate higher than it did before. Is that a concern here, right? That is at least the expectation of the worst case scenario, is that we do re-accelerate, that we do reflate higher. Okay, now to know, okay, how would that even happen? We got to keep our eye on oil prices as usual, as we talk about, right? Are we going to move sideways in yellow? Are we going to move sideways here? Do we come back down, or do we get back to 100? Do we get back above 100? Obviously, the worst case scenario is we get back above 100. We got to keep our eye on oil prices for the macro to see, okay, what other, because this is a domino effect, right? This causes a domino effect in rates, which we're about to go over. Now, if we move sideways in the yellow, right, we might be okay. Yes, inflation will be accelerated. Maybe headline does go up for another couple months, barely. But if we get back above 100, you start to get that expectation of a trend change, right? Because oil prices do factor into other services, into plastics, into a lot of service. It factors into a lot of things. So that's a big concern here. Okay. Now, what's bothering the market? What's bothering the actual stock market here? It is rates. It is the rate risk back on the table. We look at the 10-year yield, and what do we see? It's still climbing this trend. It's still in a bull trend. It's still pressing a breakout above this level. Interest rate risk is what the market sort of, the stock market, at least in crypto, a lot of markets that deal with rates, the higher the rate, the lower the valuation on the stock, right? The higher the rates, the more other systemic issues you get going in. So rate risks back on the table. And I think that's because oil prices are starting to surge here. Okay, oil prices are going up. So it's factoring that in. Next, and what does oil do also? You got to keep this in mind. Oil pushes up rates, which also are going to put pressure on the banks. Because as oil goes up, as rates rise in the treasury market, which you're getting as the treasury bonds, a collateral fall. And that's why I'm looking at KRE right now, right? The regional banks. Back here, this highlight was the collapse of the regional banks. This is when rates pretty much climbed to too high of levels. The Fed kept hiking and you had a collapse. And that was the banking crisis. Now, we didn't get nothing. This was actually the bottom of the market, and we'll go over that later. But looks like we're at risk, right? On the technicals, KRE is starting to roll over again. This interest rate risk is back to the high levels, right? So are we going to get another banking crisis? That's the question. Are we about to get another banking crisis? Is that bearish? Is that bullish? We'll see how that plays out. But this is the worst case scenario. Now, of all things, right? Interest rates go higher. That actually, let me make sure. Okay, yeah, rates go higher, and there's a flight to safety to the dollar because you get interest rate risk. Because also, I mean, if rates are higher, you're getting more yield on your dollars, right? So people are more interested in holding the dollar. It becomes the new bond. The dollar becomes the new bond market because you're yielding that risk-free money market fund rate. Held at the Fed, just look at your money market funds. A lot of people are, a lot of institutions are paying high. So the dollar becomes more valuable as oil goes up because rates go higher. And, that's a big risk to the market because higher dollar typically is a risk off signal, right? But the question is the dollar moving higher because it's a flight to safety because there's big worry in the market? Or is it just people allocating more yield towards the dollar because the dollar is going to yield you some income? Are they splitting their portfolio up, right? Let's get some dollars in there. Let's yield on that cash and get some equities. Or is this a pure risk off move for the dollar to move higher? Is this purely get out of stocks, get out of equities, get out of all risk and just, hold your dollar, right? That's the real question here. But however, look at the VIX. The VIX is not moving, right? We're getting this interest rate risk. We're looking at the next Fed hike. Are they going to hike? What are they going to do? And the VIX is still, still sideways. It's not really moving. So it's not really responding. No one is buying equity insurance. No one's buying insurance against the equity market. Okay, let's turn to credit risk. Are we seeing credit risk? No. Credit risk is sideways. There is no equity credit risk. Equities are still risk on. Okay, no equity credit risk. And I'm going to briefly talk about why this is. Well, let's talk about it. Why is there no equity credit risk? Simply because most of the stock market, most equities, right, companies have locked in lower rates. They don't refi till 2030. That's like 50%. So most companies already locked in low rates. They're not really, the Fed funds rate isn't making a big deal to banks. Yes, because they hold treasuries, right? Banks hold treasuries. Therefore, their collateral is falling where, companies, on the other hand, they already refied at low rates, so they're not really in trouble, right? But it could cause a collapse if 10-year yields go up. So that is a risk, right? But so far, it looks like maybe this risk off move is, okay, well, let's lower our expectation for equities, but let's not get rid of equities, right? Because we're not seeing a major sell-off. Now, put to call ratio, simple risk off move. We're not seeing it, right? It peaked out earlier. It peaked out earlier in the month. I think going into Jackson Hole, and here we go again. We're peaking out again. So put to call ratio, there is no put buying, right? No major risk off. And I think this is why. I think because even though the expectation for headline inflation is now going up, we're actually getting a rotation. Something is switching here. Before it was higher for longer, core inflation, it's going to stay sticky. And this is core inflation right here, expectations. And headline was dropping like a rock. Now we're getting headline reaccelerate to a small degree, but the core is expected to go lower. So we're expecting core to still fall, right? Cleveland Fed, the market is still expecting core inflation to come down. So I think that's a definite positive. And if we look today at the expectation for the Fed rate hikes, they went down, right? Yesterday, they came up to 9%. They went up to 9% yesterday. Now they're back to 7%. So the market is not expecting a hike, right? And I think it's because of what we just went over. There's a lot of interest rate risk to the market. Now, right, reverse repo cash is coming, sucking in all the excess treasuries. So here's the other upside is, and this is a little more technical, but this is reverse repo liquidity that's been draining out of the Fed and coming back into capital markets, right? This is what I'm saying anyways. And you might see some other people talk about this, but the money parked at the Fed since 2021 is now leaving the Fed. And where is it going? Well, I think it's sucking up some of these short-term treasuries that are being offloaded by the US Treasury for debt, right? So another reason rates are going higher is because there's more supply of U.S. Treasuries on the short end, on the long end, wherever it is. But you can see the rates peaked up here. At the same time, the reverse repo liquidity started coming into the market. Coincidence, right? And rates coming down is also a reflection of these bonds being bought up, of more demand coming into the market. So I think this reverse repo liquidity, right, using common sense. Could be wrong, but that's what it looks like. Rates come down as soon as this reverse repo liquidity starts leaving the Fed, and why it's scooping up better incentive here, right? If you get these short-term rates, well, you're getting 5.5% pretty much in 3 months, not a whole year. So you're getting a better yield there. And I think the bond market is going to keep sucking up these treasuries. Therefore, the S&P is not rolling over. We're not seeing the S&P roll over, right? Even though this is the worst case scenario, the worst case scenario is that this reverse repo liquidity would stop going up. And I'll tell you why that'll stop going up in the next slide. But it also, look at S&P. Maybe it's not just sucking up US treasuries at the short end. Okay. Maybe it's also going into equities 1-for-1, right? S&P reverse repo liquidity are moving pretty much 1-for-1. That's very interesting. Okay. Very interesting correlation there. Now, here's where things get nasty. If the Fed does hike, right? If the Fed does hike, we're at 5.5%, right? Upper limit for the Fed funds rate. These short-term 3-month bills, so their next quarter, right? You could think of them as quarterly income. You're getting pretty much 5.5% there on the 3-year treasury. So you get 5.5% in 3 months. That's a really good deal versus 5.5% yearly. But right, the difference is this is risky because if the US bond market blows up, well, you might get 5.5%. But if you blow up your collateral, you're getting 5.5% with less collateral, right? Where this is risk-free, right? The Fed interest rates or at the money market funds, you're getting 5.5% risk-free. Now, if the Fed hikes, what does that do to the liquidity in the money market funds? It says, okay, well, there's a higher incentive to get 5.75% up here. I might as well get 5.75% up here because the Fed increased liquidity. Also, why would I be in equities? That's more risk to the market. That's more risk to the banking sector. So this creates incentive for that money market fund liquidity to leave the stock market if it's there and go back into the reverse repo to collect this extra cash, right? So that's another risk if the Fed does hike. But if the Fed does hike, they're essentially causing more stress, extreme stress on the actual banking sector. And let's go to that, right? The regional banking sector, KRE. So if they do hike again, regional banks are in trouble. Regional banks now are paying a higher interest rate. They're taking in less cash. Their treasuries fall because, people keep selling the bond market. So they might be in trouble. But what happened the last time? Now, this is worst case scenario, but I think you get maybe a value at risk shock in the bond market. In the stock market, value at risk shock, right? You get a quick shock, but then what happens? The Fed steps in, right? Here's what we got last time when the Fed kept increasing rates. You had the Fed balance sheet start to step up. This was the bank term funding program. This was a way to keep the actual banking sector from falling apart. The FDIC steps in, bank term funding program is created, and you create more liquidity. Yes, liquidity is down from those levels, but if you get another collapse like we did back here, what happens? Well, expect the Fed to step in, right? They show that they're not going to let this system collapse. They will step in, right? Is that a guarantee? No, that's just their behavior. Watch what they do, not exactly what they say, right? So going to the technicals, right? Looking at the technicals of the S&P, we already saw that they are staying in line. So we did have some Fed speak today. And now that 4,400 level, is it being violated? Well, it did. And now it looks like it's turning into resistance here. So my expectation is, look, we have inflation. We don't have no big data, but we do have the inflation rate coming in. We also have Fed speakers probably speaking right now, actually, and we'll go to Twitter and see what they're saying. But 444 is the big level. We dropped that level, okay? And we are green today, but we're finding resistance against that level. So it looks like we are going to trade back down and find support somewhere else, right? That's what it looks like in the immediate short term. Point being here is that the market, at least in the S&P 500, is now showing resistance. It's showing a bearish price action in the next week, and this might be leading up to the inflation rate. When is that? That's the 14th. Let's go to the 14th, right? So this is the 14th. This is basically when we get the inflation rate. It's not that far away. So we're looking at possibly a sell-off into that inflation rate. We should be meeting expectations. Let's say we don't meet expectations. If the market cannot meet expectations, maybe we fall even further, right? So core inflation though is now falling. That's your upside. Core inflation is falling. It's expected to fall. Headline might go up, but that is also expected. It's not a surprise. And the market is usually looking at surprises, flipping over to the Qs. Oh, same thing. The Qs are losing that support that they had, or that resistance is becoming another resistance from the Fed symposium, from Jackson Hole. So now we're back into bear territory in the short term. It's not, fully bearish because we're still in the uptrend, right? The overall market is still trending up, but we're going to have to retest the trend and find a new support. We are still making higher lows though, so I wouldn't be so, concerned. So looking again at if we look at the S&P futures here, we can see that we've made higher lows in this whole cycle, right? What is the upside? Like I said, a lot of debt for the corporate world, or at least for a lot of debt for the S&P 500 isn't really due to roll over. So it's not that concerning because they're still locked in lower rates. You're making higher lows here. We also know S&P earnings are being revised up, right? The S&P earnings are being revised up. So who's really in trouble if the Fed does hike? Who's really in trouble? It is regional banks. It is companies who are not profitable. It's companies who cannot who do not have pricing power in a high rate environment, who are suffering from those rates. And so I think what you're going to get, or what we're going to see here, is the S&P keeps chugging along here. Even if they hike rates, it still goes up a little bit, but you're going to see a lot of other companies, maybe in the the small caps, really start to struggle because rates are too high from them. High for them. They have less liquidity, right? They have less liquidity, and that money market fund liquidity is going to leave. That's the big risk here. This has been propping up the market in the short term, right? It's been the money market liquidity right here, one for one with the S&P, pretty much has been propping up the market to some degree. Maybe not exactly coming in the stock market, but it's capping rates, because the liquidity goes in, it buys bonds, it buys US treasuries, and it caps it. But if that stops coming in because the Fed hikes rates and incentivizes this money to go back down, then the market's probably going to be at risk, right? And you might just have a sideways action in the stock market. You might have sideways action. The economy is recovering, so you don't, there's not a real big risk. The economy is recovering. The real risk is that, companies who don't have pricing power, companies who have a bad balance sheet, who are purely risk assets, they're going to be at risk here, and we start to see a switch into more profitable tech. Oh, Apple's selling off. Well, Apple selling off, that's it's not a rumor, but right now it's an overreaction. The market is, the market typically overreacts because China is banning Apple iPhones and they're kind of returning the favor to us, banning for government officials, right? Are they going to go to the actual citizens? I doubt it. They'll mess with their GDP if they actually do that, but that's the expectation right now. So we're getting short-term volatility off of this. And again, this reverse repo facility money is looking, what is the Fed going to do? That's why it's so important to see what the Fed's going to do going forward. So the inflation rate is going to give us a good expectation going forward on that. And that's set to be the headline, at least a little higher than it was. Now, what happens if oil actually slows down here, right? Because this is going to change everything. You're at the top of the trend. If oil does slow down, okay, and move sideways, then your inflation is pretty much zero. Now, I know the expectation for CPI is supposed to come in higher, but if we look at the beginning of August, this square right here is where energy is going to factor in, where oil prices are going to factor into CPI. It's this square right here. You see the last one, right? The last zone, CPI went up because oil prices, energy prices went up. This time, energy sideways. It's pretty much sideways. You could say it did go up. It closed the month a little higher, but compared to 17.5%, it closed up 4%, right? So not too much. So I think CPI is actually going to be flat. I think we're going to come in around 3.2, maybe 3.3. Nowcast has it at 3.5, 3.6. And we'll see exactly how that plays out. If you set the expectation higher and it misses, that's actually bullish for the market. So I think, again, like I said, the market's going to be consolidating into that inflation print, and then again into the Fed's meeting on the 20th. All right. So I'm going to double check to see what the market is looking at here, or what the Fed speakers are saying. And then keep in mind too, like some of the stocks that are doing good right now, Tesla, right, just announced plans to install 20,000 EVs. So they're growing, they're still expanding. We know they have fast revenue growth. Oh yeah, 5.5% interest rates. Well, they're growing revenue much faster than that. These companies are growing much faster, which is why they're going to outperform, while the unprofitable companies are going to fall apart more likely, right? They're going to more likely to fall apart. Plus, you get the fiscal policy coming in on the second half, right? Inflation Reduction Act. Who's going to benefit from that? Who's going to benefit from the CHIPS Act? We already know. So that's why this is going to turn into a stock pickers market if rates stay higher, which it looks like they are because oil's up, right? Now, if oil surges to 100, really you got a big risk off. But if it just stays up here a little higher, then you just get less breadth in the market, right? You might have a sideways market here. Maybe the Qs move up a little bit because they can still out earn. They can still create more revenue. You have short-term headwinds from these big tech companies, but we're in seasonally weak period, right? September is seasonally weak. And remember August, we talked about this the other day, when August is actually down, then September actually is up, right? I think like 60% of the time. But when you're up 10% on the year for S&P, you're not really ever down in September. So the market is kind of looking at that information and saying, maybe we're not going to be down that bad, right? But keep in mind for Tesla, here's some of the catalysts, right? M3 refresh, we already saw that the Model 3 Highland looking really good. Cybertruck, we got Cybertruck Q4 or Q3, Q4 Cybertruck coming out. FSD licensing, right? FSD OEM licensing deal. Hey, that's a possibility. Depending on where you put your expectations, you could take it off the table. Either way, you get the 7,500 EV instant rebate for Q4, going in a instant rebate for Q4. So right now it's a tax credit, but coming 2024 for an EV, you're going to get a pure rebate. So you go buy the electric vehicle, and look at this is why I have the price of oil up here, because what's happening is gasoline is becoming more, to own a regular vehicle is becoming more expensive, but it's dropping for EVs, and Tesla is going to be one of those catalysts, is going to be attached to that catalyst where, okay, energy prices are too high because oil's going up, gasoline's going up, but the cost to charge my vehicle is lower. Okay, so big catalyst there going into Q4. From my view, Tesla buying back $10 billion shares, are doing a buyback, right? So that's big. And then also full self-driving, when does that fully come out, right? That's going to be a big one. When does that actually fully come out? They should be coming out with in 2025, a $25,000 to $30K compact car. So they're doing a lot of things over there on Tesla. Apple has some headwinds, obviously. There's no headwinds in China for Tesla. Tesla's probably going to be outperform a lot of these companies other than the chip makers. Okay. So again, keeping oil up there because that's the biggest risk. We're going to keep our eye here. The next level is what, 92? I think about 92. Do we get there? I don't know. I'm not going to say I know if we get there or not, but I just know this is a big risk to the market. Pushing up inflation expectations. So here's the Fed speak. I'm going to go over what Williams just said. He just came out. I know you guys probably have comments on here. Like I always say, if you have comments on YouTube, it's a little easier to see them. They'll stick up there. Yield curve inversion due to people parking at money market fund over the 2-year bill. Yes. The inversion is the money market fund inversion it's kind of a bear steepener right now. So if those short-term rates come down at all, then it's going to be okay yield curve inversion. But right now, long-term rates are going higher. So it's a bear steepener, right? It is a bear steepener. But again, that money market, there's still, look at only 700 out of the $2.5 trillion of money market fund. I'm sorry, I like to call it money market fund liquidity, but it's RRP liquidity at the Fed, right? There's 2.5 trillion parked there from 2021. It went up to 2.5 trillion. Now we're at 1.8 trillion. So there's still another $1.5 trillion to come out of that fund. Is it all going to come out? I don't know, but there's still enough liquidity or cushion to basically cap rates, or to basically bring liquidity back into the market. And that's going to be all up to what the Fed does. The Fed knows if they hike rates, they're going to pull liquidity out of the market, hurt regional banks. And, maybe they don't do that. But if they pause, that's going to signal, hey, a cap on rates. Therefore, you get the 10-year actually come down, and you get the yield curve inversion in a healthy way. So our reinversion, I'm sorry, steepener in a healthy way. So I don't know if I answered that question. Anyways, so what else do we got on here? We got man, you guys really throw your comments on. It's just a lot easier on YouTube if you do that. Christmas rally, let's go. Yeah, oil. Hey, oil maybe does go up, and also oil surging is going to help energy company earnings. So yeah, you get interest rate risk. What you do is you get a selective market. You get energy stocks go up a lot. You get mega cap margin, pricing power stocks go up basically. and all the other stuff just sucks, right? It's kind of flat unless it has another catalyst. So that's what it's looking like. All right, so we're gonna read what the Fed is saying right now. And we got the beige book. If you want to see kind of simplify what the Fed said yesterday, go ahead and check out the newsletter. Subscribe. I sent it out yesterday, and it's just an economic review of what the Fed is saying overall in the economy. It's pretty. I don't want to say it's dovish or hawkish, but it's like, hey, the economy is cooling overall. It's cooling. That's what they want to see. I believe the Fed does pause here. I believe they do pause here. Yes, we're going to get inflation print beforehand. That'll actually confirm whether they pause or not. Those expectations will give us that confirmation. So we got to wait. But so far, I think they pause because core is coming down, right? Unless they switch and say, oh, we're worried about headline now. And I would be over 100, but until we get there, I'm not too worried about headline inflation when it comes to the Fed. But I am worried about headline inflation when it comes to the dollar surging, right? That's an issue there. All right. Where is he at? Bank Fed Williams. Okay. So this is one of the Fed, and we're getting a lot of Fed speak this week. There's not a whole lot of data other than the ISM, and yes, prices on the ISM were higher, prices paid, but I mean, we'll see how that plays out. Fed Williams, there's still more data to come before the next FOMC meeting. What is he talking about? Inflation, purely inflation, right? We're looking at these oil prices. What are they going to do by the time we get there? Fed Williams this is always Fed Williams, so I'm not going to say his name again. Inflation is far too high, but moving down. Okay, so we're getting progress on inflation. Thanks, Aqua, for switching over. I appreciate it. Now I can see your comment, and I will get to your comment. Big Man's coming. What up? That level is so important. Institutions are selling to push it lower just to push it higher. What are you talking about, Big Man, again? What level exactly? Thoughts on BNB? Okay, yeah, I'm gonna get to that comment. Let's just go through Fed Williams, and then we'll do the Q&A, or we'll do the technicals and all that. So inflation is far too high, but moving. That's progress on inflation. He's signaling progress. Labor market imbalances are evening out. That's a dovish, right? That's good for the market, and we are getting a rebound in the S&P right now, I believe. We're getting a small rebound, but we're below 444, so it's not a whole lot of conviction yet. We're seeing movement in the right direction for the economy. Yes, the economy is recovering. We're seeing that, right? GDP forecasts are going up. Earnings are going up. Oh, the consumer is in trouble. Not exactly. I know people say consumer debt is at all-time highs, but the debt is always at all-time highs. That's always been the case for the last 50 years. Debt goes higher, and so does the stock market, right? So does the economy. GDP goes up. That's what fuels GDP is debt, right? It has to be productive debt. The question is disposable income to debt. That's the real question, and that's down from 08. So when you take the ratio of disposable income versus household debt, it's not going up, meaning people have enough disposable income to keep spending. They have jobs to keep spending and paying off their credit cards and keep paying off their whatever the debt is. So that's the real issue. There's the real issue is, are they losing jobs? Can they still pay for and service the debt, right? They can. So it's not a big threat yet. It's just not a big threat yet in my view. I don't see that. We're seeing movement in the right direction for the economy. The Fed has done a lot on monetary policy. Okay, yeah, they're saying, hey, we've done enough. We need to hold. And remember, as they hold rates at the level, they're still putting pressure on the market. Just holding the rates there, that is the lag effects coming in. So they're still putting pressure. They don't need to keep hiking, right? Unless there's some type of big risk coming in, which I don't see that. The question before the Fed is, does monetary policy need to become restrictive? I don't get what he's saying there because we're already restricted by 2%. But if oil goes up, if CPI goes up, it actually makes policy less restrictive because you take Fed funds minus the inflation rate. That's your cushion, right? That's your restrictive level or your restrictive bandwidth, whatever you want to put it, however you want to put it. And so inflation moves up meaningfully, they might have to hike rates on CPI. But if they're only looking at core, it's not going up. If they look at core, right, we have the lag effects from housing coming in, rents decelerating. And if that's the question, we're going to become more restrictive. So what does the Fed focus on, headline or core at this point? Policy is at a good place as the data dependent. Demand in the labor market is coming down. Okay, yeah, demand is coming down. The open question is if policy is restrictive enough. Yes, that is the question. Are we restrictive enough? And the Fed doesn't know, right? That's the other uncertainty about the market. The Fed does not know, but the market is pricing in a pause right now. If that changes, we're going to go back to the retest, probably 431 is my expectation. If that does change, if you're forecasting very small positives and quarterly growth, oh, this is the Bank of Canada. Okay. Bank of Canada looks like they're going to pause also. You can't rule out that you couldn't get a couple of negatives. We don't really care about the Bank of Canada right now. We're talking about the Fed, the big central bank. Fed Williams, the latest consumer spending data has been strong. Okay, see how you get conflicting data? Consumers are slowing. Consumer spending data is strong. And what it is certain areas are weakening, right? We saw that. We read the beige book. People are spending less on unnecessary things, but the people who are wealthy are spending more. What up, Polar Vortex? Nice to see you. Haven't seen you for a while. And yeah, we'll talk about Tesla. We'll get into Tesla. I know you're bearish at this point. You're probably seeing that reverse head and shoulders. Fed Williams are that head and shoulders. I see risk of stronger than expected growth. So that is a risk stronger than expected growth. Pushing up PCE, pushing up prices in general. And we kind of see that that's sort of the risk there, that they might have to hike later in the year. Maybe not now, but later in the year. So we'll see how that plays itself out. So that's a hawkish comment. I expect the unemployment rate to edge up over the next year. Well, if that edges up, that keeps them on pause. Remember, if they keep rates here, they're pushing pressure. They're actually increasing pressure on the market by just holding rates where they are at. Okay. So this is what Bank of Canada, True Canada Employment. Also, Polar Vortex. Just so I can save all your comments. If you want to jump, I'm live on YouTube. I got the charts on YouTube, and I'd love to go at it with you. On YouTube, your comments are saved where it gets lost here on the TikTok algorithm, or the feed. It gets lost on the feed. So if you don't mind jumping over, actually, the YouTube link in the description. Hey, like, subscribe, and yeah, I would appreciate that, Polar Vortex. And I can see your comments also. I don't get lost. It's a lot easier for me. So that's what the Fed is saying right now. Now, Aqua, thoughts on Stone and BNB being added to the S&P 500? You think it's going to go higher? Stone. All right, so let's do this. Stone. I don't know who Stone is. Is Stone? I don't know who Stone is. I've never heard of him. BNB. I mean, obviously, Airbnb being added to the S&P 500. Usually, yes, it's pretty bullish typically. Now you want to know, you want to think where's the market headed, but this is bullish for the most part because you're going to get forced buyers to buy Airbnb. Oh, Blackstone. Okay, what's the ticker for Blackstone? They're going to it's going to force buyers to come in and buy Airbnb. And yeah, that's pretty bullish for Airbnb, I'd say. Airbnb looks very good on a technical basis. I wouldn't say I'm so bullish on Airbnb for the super long run, but it does look it's pretty bullish, right? There's a lot of demand for Airbnbs, and if they can innovate and keep up, and it might be bullish too because this may be a thing in the future, right? Renting versus owning rates are just too high. So maybe that's pushing it up. There's a lot of people building apartments, multifamilies. If you can Airbnb those, maybe that's bullish for the stock. I don't know the fundamentals to a T. BX. Okay. Let's look at BX. BX, we got who is Blackstone? What do these guys do? That's pretty bullish price action too. I like that price action, right? Broke trend. RSI is moving up. Simple moving averages are probably on point. Moving off the 50-day. This is one of the only stocks actually moving. What do? They're moving above the 50-day moving average and breaking new highs. If I had to guess, I have no clue what they do. What do they do, Aqua? Let me know what Blackstone is. Because yeah, that's interesting. Because that's some that tells you where confidence is in the stock market, right? This is going to be a stock pickers market with these high rates. It's going to be a stock pickers market. It's not going to be everything goes up because rates are just too high. Inflation is still elevated to some degree. There's still uncertainty in the market. So who is certain to earn that's where probably risk is going to go to. What up, Polar Vortex? Tesla keeps cutting their prices. I guess when I get to zero, they will have 100% market share. Yeah, Tesla cutting their prices. I know people think they see it as bearish, but they are gaining more market share, right? Just think about it. I mean, you already thought about this. You know how it goes. If they cut prices, they gain market share. They won't go to 100% market share, but you take, people are going to see the EVs and be more bullish on the EVs. You're getting government stimulus supporting that, right? The tax credit. And essentially, people are, you're going to get demand because oil prices are too high. The cost of an EV is dropping. So that brings in demand. That's a flood of demand there. If it doesn't happen, it doesn't happen, but I'm pretty sure it's going to happen. That's why we watch the deliveries. We watch the production numbers, the delivery numbers, and we'll see if demand ticks up. If it doesn't, then Tesla will have an issue. Gigantic Head and Shoulders. Yeah, everybody's watching that big Head and Shoulders on Tesla. Global investment business investing capital on behalf of public, private sector, pension funds, insurance companies. Okay. Okay, global investment. Interesting. That's very interesting. Do they pay a dividend? Do they pay a dividend? I've never heard of them. So yeah, the Head and Shoulders that he's pointing out, and you could do this two ways. Here's what the Tesla bears are pointing out when it comes to the Head and Shoulders. Get the big shoulder from 2021, the big head, obviously, and then here's your lower shoulder. I mean, it's pretty much at the same pace. So you have to break under maybe like 200 would be pretty bearish. And you could draw charts anywhere, but there's too many catalysts in my view, way too many catalysts. I remember you were bearish earlier, polar vortex, and you were shorting. Hopefully you got out and didn't get wrecked because, Tesla ripped higher. We're now above the 200 daily moving average or above the 100 daily moving average, and we're on trend. Tesla is still on trend. I would get bearish on Tesla if it does break below about 208. I'm gonna say 208. That's where I'd get a little more bearish. You've been doing good with Nvidia. Nvidia's been on fire. Yeah, Nvidia has been on fire. Apple is kicking me in the sensitive area. Yeah, Apple got smashed. Let's take a look at Apple. Is this really going to hurt Apple? I mean, they got right back down to support. Now there's another way to look at Apple here other than just, oh my gosh, China, blah blah blah. Right? This is, to me, it's an overreaction to the downside. Which you are seeing is that it is supporting. Apple broke that trend a long time ago, but they're supporting the previous high. They're still holding the previous high that was put in. And let's take this off. The previous high, put this on the weekly chart so we can see those candles a little clear. It's still supporting the long-term resistance level. So we're still good here on Apple. And it looks like it's just going to wedge. This is pretty bullish. Looks like it's just going to wedge as long as it holds 170 at least 170. Yeah, 170 to 175, and he probably needs to hold that level. But a lot of buyers coming in here for Apple to buy that up, and you can see that on the wick. So I don't think it's going much lower. Come on, polar vortex, jump over to the YouTube. Way better for me. That's a good idea. I know you're gonna blow up the stream. BX is in basically everything, including major real estate holdings. Okay, I didn't know that. So global investment business, so many stocks out there. Global investment business. You know what? That makes me want to look at the fundamentals. Let's take a look at the fundamentals here on BX. I've never seen that. I've never actually seen it before. Let's see. BX is just capital allocation, right? That's a big company. Blackstone Asset Manager. Okay. So this is one of the big asset managers. I wonder if they're going to be buying Bitcoin. I did give her my short and told you once it broke above this year's trend, you would cover. Okay. Yeah, I'm glad you covered. That was nasty. You disappeared for a while. I just didn't hear you anymore. I thought, oh man, this guy must be getting wrecked. But now you're back, right? Look, Tesla looks kind of bearish. Now you're back. Dividend at 2.93% every 4 months. Okay, interesting. 3.31 it shows on here as a dividend. Sales 6 billion, income. So leverage to debt. Okay, that's okay. Forward PE is low, so it looks like their earnings are going up. Definitely earnings going higher. Profit margins. Operating margin 32%. It doesn't show their gross margin. Price to sales 19. PEG ratio. Income 1 billion. Well, it looks like they're. I wonder what they're holding. I wonder what assets they're actually holding. Who are they competing against? I'm looking at BX here. So Blackstone. Oh, Blackstone is larger than BlackRock, huh? I guess BlackRock just manages more assets than Blackstone. That's what I'm guessing. Bank of New York Mellon. Hey, all these guys are going to have to tokenize their assets. That's why I'm so bullish on crypto. Very bullish on crypto. And I want to know what some of your guys' thoughts are on that, including Polar Vortex, Bank of New York Mellon, Swift. They're all talking about tokenizing their assets. Bank of America, Citigroup, and they're using the Chainlink protocol, and they had a successful they were successful in using the experiment with Chainlink. What do you think? What do you think about that? I know you think crypto has no use case. I believe, maybe I'm wrong about that. It's been a while. Not every 4 months. It's 4 times a year. Okay, so they split it by 4 times a year. Okay. So yeah, Apple looks still pretty good. I like Apple. Apple looks straight. Um, as long as it holds that level. Microsoft still lifting. Microsoft with the nice little pullback there. It's probably going to form a wedge too, my guess. I know the energy sectors are pretty bullish. Um, yeah, KRE is what I'm worried about right now. I'm not worried, but KRE, it's like, is it going to trigger the Fed to step in again? Are we going to get that collateral fall for KRE and then the Fed steps in and then recycle, pushes up the market again? ET, bullish on crypto happening is this coming year. Yeah, happening in 2024. Really, I know people love the happening, but the real bull story is the liquidity cycle, right? ISM is starting to bottom out here. Oh, energy transfer. This is a weird looking chart. ET, energy transfer. Wow. That thing is going straight up. Probably does really well. What is ET? What is ET? What do they do here? Oil and gas midstream. Yep. They're probably under what, XOP? I'm guessing they're under the XOP ETF, which is very bullish right now. Very, very bullish. Um, Vale, yeah, a lot of people are bullish on energy now, especially because their earnings were so low. They had very low valuations. So a lot of energy plays there, except for like look at these solars. They're still dumping. A lot of these solar companies still dumping. Unfortunately, for those of you holding it. Let's go in the log chart. We got to go in the log chart here. Retail still down, utility still down. So, I mean, let's say the worst case scenario does play. Oh yeah, ZM. We're gonna get to ZM too. ZM looks really strong. Let's say the scenario plays out for most people. It's probably hold cash, collect money market fund. Collect that interest on your cash. Um, do you really buy bonds? Probably not, because the economy is strong. So there's no reason to buy bonds. Everybody thinks there's not everybody, but I know a lot of people are signaling recession. It's not going to happen with what we're seeing here. We're just not seeing it. The consumer is fine. They're slowing down, but they're not collapsing. All this debt, that. That is how the system works. You need a real shock for that to happen. And the Fed's all over it, but the dollar is breaking out. So you have that. And then you have energy breaking out, right? So do you have an energy play? Do you have energy play? Or do you think it reverses, right? Because demand is down, because China is not online. If we look at the other commodities, look at nat gas, very suppressed. So I don't really, this might be bullish for energy, but not necessarily inflation. Nat gas cannot get above this level, right? And that probably looks different depending on what you're looking at. I'm looking at futures here, but nat gas still pretty suppressed. Copper still wedging. Maybe copper breaks out, maybe copper does break out eventually when the economies start to reaccelerate and you get the manufacturing index up a little bit. Wheat still making new lows. So there's no commodity inflation in the pipeline right now. It's just oil going up. It's a trade. I mean, OPEC, well, Russia, who is it? Russia, Saudis keep cutting production, pushing that up. And then, yes, the US has to replenish the SPR at some point. But there's other companies or other countries who are actually cutting, right? So that's another thing, are not cutting, increasing supply. So I'm just keep my eye here over 93, probably get really bearish, rates go up again, and we'll see how that plays out. ZM, Roku and ZM, forgot about that. Roku, yeah, Roku. Whoa, Roku had a big push and it just came right back down, huh? Let's go to that daily chart. Big push, came back down, and I'm going to turn on the trading stuff in a second here. Just FYI, I don't think the market's going to make a choice until we either sell off into the inflation rate next Thursday, we move sideways, we sell off into it. Do we bid up into it? I don't know. We'll see which way the market really makes a decision, which way it goes. We'll look at the support and resistance to tell. But for now, I think we're just going to move sideways. See, Roku made that big blow off top, coming back down. It looks like it's forming a wedge here. So Roku, nice setup here, right? Forming a wedge on Roku, holding that 50-day moving average, right? A lot of risk assets are holding the 50-day moving average. And then you go to ZM, and ZM is, how's that volume looking on ZM? Hey, where's the RSI? Why is it not there? It's weird. Oh, there it is. So looking at the volume, yeah, you're getting some volume coming here, especially this could be fuel. Also, what is it? Josh Brown is buying ZM, also buying Zoom stock. A lot of people, they have good fundamentals, really good fundamentals on a technical basis. It is set to break out. I think it's going to really break out over 75. Looks good. It's consolidating at the highs, right? So your highs were at 72.50. Now we're holding that 72.50, right? You got the rejection here on ZM. I know there's a lot of stuff on here, but you got that first rejection. Whoa, what the heck? I don't know why that did that. Okay, so you got that first rejection here. What the heck's going on with my mouse? You got that first rejection at 72.50, and now we have two wicks holding the 72.50, right? So that's pretty bullish. There's a narrative behind ZM, and especially if, I don't think the breakout, there's going to be some type of pandemic breakout. I wouldn't bet on that, but if it does, that's probably going a lot higher, right? Telecommunications network. Sugar. Sugar's going up. Yep. If you recall, I have also been very bullish on Elf Beauty. Hey, that's a good one. Elf has been Elf is really strong. I think Ulta was up today too, but Elf is one of those retailer stocks that has just been on a rampage, right? Since the lows, from the lows, this thing bottomed when inflation bottomed, pretty much before inflation, up 500%. That is insane. This is the gig economy, right? 322% from the highs, from the breakout. So Elf Beauty just on a rampage, holding that 50-day moving average. That's insane. That's absolutely insane. I think this is, the social media economy is. I mean, hey, you're not going to stop buying makeup. Very bullish there. Yeah, Josh on Meta. He said he's going to trade Zoom, but we'll see what he does. Uber recently held the 50-day move. Man, I hate Uber. I don't know if I could say that on here, but I don't hate Uber, but I just don't see the use case for Uber unless they rent. They're gonna have to buy some. They're gonna have to start renting some vehicles. But also, my thesis is full self driving destroys Uber and Lyft unless they jump in and join. That's my thesis here. I've been telling people health beauty is the way to play TikTok, since you can't buy TikTok because of Chinese owned ByteDance. Health beauty, don't know what that is. Oh, Elf. Okay. Probably. Yeah, a lot of beauty products on the market right now. All right, so let's see. Let's double check. Yeah, so going back to S&P, we know, Zoom, Roku's looking good, Zoom's looking good. Anything else you guys want me to do some TA on? I can do that. A lot of people are calling for this head and shoulders on S&P. We're on that the S&P. Let me take the volume off to remove some of this stuff. So you can see we're in that the upwards trend right now for S&P. Actually, maybe you can drag it from here. Right? We're on an uptrend. If we break this trend, then we still have some room, but we'll come back into that 431 or 4 I guess SPX looks a little different. But we're still holding the trend. We'll see where we end up today. Ulta is also a good one. Yep. Ulta. Yeah, Ulta. What does Ulta look like? I know they did struggle for a while. Yeah, they sold off pretty hard. I wonder what the difference is. I don't really know these industries that well, but Ulta holding the 400 back in the day, Ulta was pretty strong. And then Disney, I know a lot of people are looking at Disney. Disney just looks bad. I don't know. Does anybody know why Disney's so terrible? Let me see. It's probably oversold though. This is probably a buy area, honestly, for Disney. It's not like the overall business is really gonna. So Disney is back to the pandemic lows. Wow. Your big low, the very, very bottom was what, 78, 79? So yeah, you're back to the pandemic lows. We'll see if some buyers come in there. Probably. My guess would be they do. Target, did they ever recover? Still rolling over. Target looks bad also. Bitcoin still holding 25K. That's the level. The moving averages look really weird, but sometimes you use an exponential on that. So yeah, Bitcoin looks pretty good. Ethereum looks even better. I think Kathy Wood said today that she expects Ethereum to outperform Bitcoin in this next cycle. So do I. There's more wallets actually in Ethereum. There's more long-term holders, and ARK just applied for the Ethereum ETF. We'll see how that plays itself out. But Disney is a value trap. Stay away from it. Wouldn't short it here either. I agree, actually. I know a lot of people like it. I think Disney is a value trap myself. One of my best friends is actually a Disney guy, so he'll probably get hurt if I talk about it too much. But I think Disney is a value trap. I think it's just a lot of hype, and it's one of those woke companies who just may not survive. I mean, they could turn it around, but they have so much infrastructure. They probably have a lot of inventory that's just yielding nothing for them. Bought 5 today for long. Who's out? You bought 5 what? Bill Gates would buy Disney. He just bought Bud shares. Short Bill Gates. I actually have Apple wind up. Oh, ESPN. Good content. Okay, Bob Iger. Straight to consumers. Okay. Yeah, I don't know too much about their business model. I'm a growth guy. I don't think Apple's a growth. I mean, Disney's a growth stock. I don't think they survive in this next era where everybody's kind of woke. They're gonna have to make some changes. And I don't think the Disney app is that great either, right? Maybe for younger kids, but I don't think it's that great. Chainlink maybe have bottomed here at this point. Let's look at some tech here. Look at some tech plays. ARK. Ooh, ARK found a bottom. This is really bullish for Tesla, for Zoom. ARK finding a bottom. Halvening coming. Yeah, the halvening. That's going to be interesting. Apple, obviously Apple, Google. We're on the weekly. Let's go. Yeah, let's stick on the weekly. Oh, Amazon. That's right. Did I have a dream that Amazon exploded? I must have had a dream because Amazon is coming out with their AI, very powerful retail AI. I think Amazon's going to definitely surprise a lot of people. Over 145 is probably go back to all-time highs above 145 once you get above that level for Apple. Google chugging along there. Meta, uh, big tech is not slowing down. Microsoft, Netflix. Oh, AMD with the great setup here. AMD still has a really bullish setup. Now it's coming down to the bottom of the flag. So, I mean, this could be it. I'm guessing it doesn't move till after inflation, but once you come into this trend, it's a nice setup there for AMD. Zscaler, head talk about a cup and handle. This is a strong cup and handle for Zscaler, cybersecurity company. They have a long way to go back to the highs. TSM making new lows. Wow. Teladoc still holding on, 22 level. Square, SoFi, Roku, Palantir. Palantir 2 still holding on. Yeah, Meta looks pretty solid. Oracle. Oh yeah, Oracle did break out of that trend. So it's pushing all-time highs. You still have a lot of breadth in the market. I just think it's a stock picker's market. It's not a full-blown, full-blown uh ENPH. So Enphase now doing the double dip on the RSI. Can it go lower? I mean, this is a long-term support. This is a 3-year long support for Enphase. And now it's doing the double dip. The RSI is lifting while it makes new lows, bullish divergence. Unless there's some type of surprise, maybe going into earnings, maybe it just sold off for earnings. Earnings are coming in October. That's going to be an interesting one. Apple. Apple holding 175.83. I mean, I think Apple's just going to be consolidating at this point. It did price in a lot of weakness there. It needs to hold about 176. It really needs to hold 170, I think. Under 170, Apple's going to probably push down the market a lot more. So 170 is a big level to look at for sure. Oh, we had Fed Bostic come out and speak also. So let's go over Fed Bostic. I know there's a couple Fed members. The housing market is driven by more than just monetary policy. Fed Bostic, the strength of the consumer has kept economic pain at bay. Yep. The US China relationship is evolving in a very significant way. That's going to be interesting. Bostic says, I'm unclear on how tension in the Chinese real estate resolves. Yeah, because I think China just keeps printing. That's about it. So yes, S&P looks like if it can't get above 444, coming back to 431 to try to retest. Just keep your eye on that reverse repo facility money. It did pull back a little bit. Is this today? It's going up again. So the reverse repo still draining there. Still draining. When it goes up, it's draining from the Fed. It's coming in somewhere. It's either coming in the stock market or it's coming into treasuries, or probably both. But it is supporting liquidity in the market. So to me, I mean, for me anyways, this is the most, I don't want to say the most bullish indicator, but you want to keep track of that reverse repo. See what the liquidity king says here. Watch move index. Okay. So the move index, he's saying the move index. Let's see what the move index looks like compared to the RRP facility. Bond volatility versus, I bet you if we invert them, they look very similar. Take this off. Let's invert bond volatility. Does it look like the RRP? Pretty similar. So the lower bond volatility goes, yeah, that's pretty similar. The lower we get bond volatility, the higher really the liquidity comes into the market. You want less bond volatility. Okay, that's what he says. Get that back to scale. So yeah, I mean, a lot of people say bond volatility is more important than the VIX right now, just because the treasury market is kind of what's causing the havoc in the stock market. Watermelon, I don't know where he's at. I haven't seen him for a while. Maybe he has a new job. I don't know. My phone was getting so hot I couldn't handle it. Oh, okay. So I got a new iPhone 14. Nice, congratulations. Propping up the Apple market. I probably need to get a new phone at some point too. So Tesla, what are your biggest takes on Tesla? What are your biggest takes on Tesla? Just do some Tesla talk. I'm gonna go through some things. I wish you could jump on the YouTube Polar Vortex so I could all your comments get saved on there also. So anybody watching the stream, you can convince them that Tesla's a trash company. If that's what you wanted to do. Okay, nice. Yeah, I'm gonna wait for him to jump on the comments because I got some stuff to run by him on the comments. It just gets too lost in the TikTok feed. But anyways, until then, I'm gonna check some other stuff. Global liquidity watch. Man, it looks like liquidity is turning up also in China. Let's see what this is. Some of this news here. Oh, I heard about that. As China starts to print. So keep this in mind. As China starts to print and debase their currency, they're essentially creating inflation and sucking inflation from other countries, which means they're going to import inflation, and that's deflationary for the rest of the world if they print enough. So that's actually I think this is a really good setup for the macro China printing. They can print. They have no inflation. Their inflation rate comes out tomorrow. Also, I think it's tomorrow. What else is this guy saying? I think that's it. Okay, so looking at the week ahead, anything significant for the market? 10-year bond is everything right now. When we press the high end of the range, stocks crater. Yeah, exactly. Very true. Let's see, 10-year yields. Looking at that 10-year at 4.25. Now, if we do a technical analysis, it is bearish. It is sort of bearish. But yields in dollar haven't really responded to technicals that much. Oil did, and then it just made a new high. So I think definitely it's hard to use RSI and divergence when it comes to a non-asset. I mean, 10-year yield isn't really an asset. Maybe TLT. You could invert it, but I don't know. With all that treasury issuance, that is what's putting pressure on the market. All the treasury issuance coming from the treasury, pushing yield rates up. So again, that's why the money market fund liquidity, if it keeps draining from the Fed, and I think the Fed does pause, and that causes money market funds to go higher, stock market goes higher. That liquidity is sucking up the treasuries, and that's a good thing. That's a really good thing. You don't want more interest rate risk. So we're not higher yet. But what causes us to go higher? Let's take a look at that. We are what, Thursday? We're going into Friday. So tomorrow's already Friday. Really quick week. And we're looking at, no, this is the 14th. Let's look at the beginning. So we get the EU growth rate tomorrow. European Union, I think their central banks are starting to turn also. Treasury purchases 25 to 30 years, continuous jobless claims. Yeah, the economy's strong, nothing weak in the economy. India, fastest growing GDP. India is growing really quick right now. So that's another, I think, tailwind for the global economy. Inflation rate for China tomorrow evening, which you're not going to see till Monday. It's not going to factor until later. Used car prices tomorrow. Next Monday, you have nothing for the US really, just bond auctions. We don't really have any great data until next week. It's all technicals right now. Till next week, what, Wednesday? Yeah, it's not till next week. Oh, it's the 13th. Okay, so inflation comes in on the 13th. So that's what the market's looking forward to. You have 4 days to trade into inflation. We got 4 days to trade into that inflation rate. And I do expect year on year to be up because oil just kept going higher, unfortunately. So the year on year inflation rate probably right now, there is no consensus yet. I think we'll see what the consensus is. It hasn't came out yet for the inflation rate, but core, on the other hand, that should tick lower. It might be a bad reading though. We might get a bad actually no, because August inflation oil prices didn't really move in August. It'll be the next print. So September, it'll be October where things might look nasty on the CPI. And the Fed may pause this time and then hike again. Who knows what they actually do? But if core keeps coming down fast enough, that's where, the market gets pretty bullish. And the market is pricing in that pause on the next meeting at a 7% chance of a hike, 93% chance they do pause. How about November? Let's look at November here. November is a 50%, 55% chance of a pause rate hike. So yeah, I can see that in November because this month oil went up a lot, and that's going to factor into the November when we come into November. No, October. Oh, so they're paused in October. All right, so there might be a double pause. Okay, so if they pause this month, there's no meeting in October. We don't come back till November. And it's going to be interesting. December, where do we get cuts? The biggest cuts won't come or the biggest chance of cuts. The market is pricing in a cut in May of 2024. So those are getting pushed out even further because growth expectations are up also. Yes, dollar rally hurts multinationals. Yeah, used car prices. You're right. Used car. I keep forgetting about that. Used car prices are falling pretty quickly. That shelter should be coming in too. It's starting to roll over. So I'm still more optimistic about CPI. I'm still pretty optimistic. I think it's flat this month. I think it remains flat overall, but energy prices definitely are going to lift a little bit. Core, I think, just keeps coming down. Is about 60% of core. Yeah, core. I think core eventually does collapse, and then that's when the market can get excited again. So just looking at things, trying to time it out or look forward, looking forward on things. The S&P could just trade sideways. I don't know what's going to live. We need another catalyst here. You really do need another catalyst because inflation has slowed. But here's your wedge pattern. Let's just take this off. Let's take this off. There's your wedge pattern. It's kind of a flat triangle, really, into 431. And I'm wondering, hey, do we come back to do we come back into 431 on the SPY or SPX 43-ish hundred, right? 4300-ish, 43.3, whatever you want to call it. Do we just keep consolidating here? Dow looks the same. Equal weight's whatever, Nasdaq's whatever. I think that's all we're looking at. More demand for used cars and driving prices up later in the year. Probably true. All right, I'll be right back. Need to use the restroom, and then we'll close it out from there. Just do a little review. What's hitting the market? What are we looking at for next week? Let's do that review. It's weird times right now. Not a whole lot of market data on the macro. A lot of sentiment. All right, I'll be right back. Okay. So, tell you what I think is going to happen here going forward. So basically, the way it looks is, Nasdaq is still, this is a Nasdaq trend. We're still in an uptrend. The bull market is still in place. Okay. The bull market is still in place. There's a lot of bears. They're upping their price targets. Morgan Stanley's Mike Wilson, he looks like a fool right now because, I mean, what is he doing, right? He looks like a fool right now because he has earnings coming down, but earning projections are actually going up. So we have earnings going up. They're no longer revised negative. Earnings are now positive, right? They're revised up positive for the first time in about 2 years. So that's definitely going to get investors confident about stocks in this environment. But it doesn't mean they buy S&P necessarily. Maybe, but I think more so you're going to get a stock pickers market, right? Stocks that can outperform rates, stocks that can still earn while inflation comes down, because inflation is decelerating, but stocks that can earn and retain their earnings and don't need to deal with aren't as affected with higher rates. And of course, you know what I think. Tesla's they can cut prices and still retain market share. They can cut prices. They're growing at 50%, 50% a year on revenue. Margins are pretty solid. My view is we have a soft September, then face ripping rally into the end of the year. That makes sense. Polar vortex. We have like a soft timber. That's what it's looking like. I agree with that. It could go either way, or we rip higher now. Now, seasonally, everybody's expected September to be weak, but I think that's going to come down to, again, next week CPI and the inflation. The Fed pause. If the Fed does happen to pause, and keep your eye on that money market fund chart that I always call, right? The Fed's reverse repo facility. As that cash keeps coming in, they just keep buying the treasury. So the the rate market, the bond yields, they might just get stuck, right? I don't see them going higher yet because we do see the Fed liquidity coming in and it's scooping up those treasuries. So if that continues, you're going to get a healthy, market here. So KRE is at the edge of collapse. If it does collapse because rates are too high, then you do have an issue, but the Fed probably steps in as they did before, right? Oil's the biggest risk here. As oil goes up, it does push up CPI, it does push up some other services, but at the same time, oil going up does improve S&P earnings. It also improves it's also a sign of a stronger economy. And that's what we're getting here, a stronger economy in the US at least. If you go to China, China stimulating, China cutting rates, China stimulating their housing market. And so really, I think there's a recovery here. If we look at the ISM numbers, right, the ISM manufacturing cycle, it is starting to bottom out. The service activity, and economic activity for services and manufacturing are starting to turn up on the charts, right? Sentiment is improving here, so that's good. And then all the debt people worry about, I mean, I don't think it's a big issue. Student loans coming back online, they probably won't pay them. It'll probably get rolled over to some degree. People just won't pay them, or they'll get more interest. And then we're heading to the election year, right? We're heading to election year where typically what do politicians do? They print money for votes. So if there is a slowdown, expect more checks, maybe even stimulus checks directly to people again, right? Or some type of inflation relief check. You know, if you qualify for XYZ, maybe we see that also. And so, yeah, I think we just move sideways here. And I think it's going to become a stock pickers market. When it comes to crypto, you're looking at the ETF. Now, this is getting really crazy for crypto, because if that ETF, BlackRock is filing for the ETF, right? Ethereum, now there's Ethereum ETFs. Now you have, now we know Chainlink is the primary, not policy, but the primary, protocol in the crypto world for central bank digital currencies, right? For cross-chain interoperability, or for tokenization in general. So those are big catalysts here. It just takes time for them to actually come in. There's other stuff we got to look at. China relations, what are they? I think the move to ban Apple is also kind of like, hey, we can hurt your markets too, right? So for the most part, yeah, I think there's going to be a recovery here. Once we get to all-time highs, I still think we're going to all-time highs. Then maybe we get a retracement, whether that happens before the end of the year or not till the actual end of the year. Where's that all-time high at? When does it get put in, right? When does it actually get put in? So a lot of the bear cases have to do with earnings coming down. That's just not the case. They're getting revised higher. We know there's a rolling recession, right? Financials are struggling. They have the most sightings on they have the most recession sightings on their earnings calls, which makes sense. Carries rolling over, right? Because interest rates are still elevated. That's putting pressure on the banks automatically while we're here. So I think it comes down to inflation. That's the next market here. Would you say the labor market's coming into balance? There is no wage inflation. We're not seeing it. About September, I'll read some of these. My views is we have a soft. Oh, okay, I read that. We actually have a decent September 8th, last 10 times. Yep. Economically, the country is very bifurcated, low and hurting. You can see it in stocks like the dollar. Yeah, there's bifurcated. Dollar General is at the same time got a big raise for UPS driver. I'm trying to read this. Make 170K. Even the part-time people had a double. I think we're in a rolling recession. I think there's some strength, there's some weakness here. And as long as there's no big surprises, I think stocks keep going higher, right? And crypto just needs the ETF to actually come online. The auto workers are seeking 46% pay raise. So yes, the economy is very bifurcated. Yeah, we'll see how that plays out. A lot of policy too. The U.S. Treasury is going to have to. I think there's going to be not a meeting, but from what I heard, they have to raise the debt ceiling again, something like that. I don't know exactly what it is. We'll see. It'll start hitting the news. I just don't think it's a big deal right now. So they have to keep printing. Either way, we're still in a bull market. The economy is stronger than what people thought. The housing market is starting to recover, mostly driven by multifamily, right? Apartment rents, not necessarily single family housing. So you're just getting a change. And the AI narrative is the big one. It's still here. AI is supposed to be bigger than the internet. It's supposed to be huge, increasing productivity. And that's really what the market's looking for. Can we cut costs? Can we keep cost cutting? Can we keep doing stuff for a lower price? And as we see more productivity come into the S&P, right, whoever it is, mostly tech, probably NASDAQ, those stocks go higher because the interest rates aren't a big deal anymore, right? There is no wage inflation. They can use AI to keep growing or to keep increasing production, GDP, and earnings. So look out for innovation. Innovation is set to really boom the way, looking at it. And I think the Fed has actually done a pretty good job. And it looks like we're going to have a soft landing at this point. We're going to have a soft landing. Unless oil gets above 100, I think we're going to have a soft landing. But that's all I have for you guys on YouTube. Appreciate you staying, and we'll catch you tomorrow to see what's going on tomorrow. There's not, like I said, there's not a whole lot of news, but usually something sets up. I'll have something for you guys. Appreciate it. And I'll catch you guys later. Stay blessed, stay in shape, keep eating healthy, and sleep well.